Hi, Kevin Wright here, back with another property finance tip. And what we're looking about this week, well, we're going to have a look at see where we are in property as we're now entering Q4. So if you're interested in what's in store for property in Q4, stay watching. Okay, so it's now September 2021. We're into the fourth quarter of the year. So where's property going to end up at in, next 3 months' time, or a little under 3 months' time? So where are we going? What's happening and what influences are going on? So I want to have a little chat about that this week. So the big thing is stamp duty and the relaxation, or in fact the ending of the stamp duty holiday. Now, it was originally brought in as a COVID measure to keep the property market afloat. I think you can say it did that because it's been confoundingly good, exceeding expectations over the last year or more. Property prices have not only stabilised, they've been buoyant and they're increasing. So from that point of view, if the Treasury's view was, well, we don't want a property crash as well as a economic crash, because we had the biggest recession for God knows how many years. It's bouncing back now, but I'm guessing I don't know, but it's the Treasury just thinking, well, the last thing we need now is on top of the economic recession, which we can't avoid because we've got to shut down, do these total lockdowns. But we can try and avoid a property recession to pile on top of that. In that case, it was very successful, wasn't it? A bit frustrating because people are saying that it's hard to find deals and everything's got 10 or 20 offers and the offers are usually over the asking price. So all of that stuff is annoying for investors because they can't find deals as easily as they could before. But in the wider text, it's worked. Now, originally it was the first 500,000. And it was for 6 months. So the big panic, it was going to get drawn this time last year. Well, it didn't. It got extended until the end of March, and then it got extended again. But this time it was tapered. So the 500,000 was until the end of July, I think, and then it's 250 since then, and now the 250 ends at the end of September. So what does that actually mean? Is there going to be a little bit of drop? Well, I think there could be a leveling off. Now I haven't got my crystal ball. I'm no Mystic Meg. You can't predict. You can only hazard a guess. I'll give you a little story in a little while later in this video about how even the best get it wrong. We'd expect a flattening off, and we're seeing a bit of flattening off in prices right now, to be honest. So in different areas of the country. So you'd expect the removal of a stamp duty holiday to have a flattening effect on prices. Will they dip? Difficult to say, because it's not the only factor that's pushed prices up in the last year, but it certainly helped. I think the happiest people in the country with the removal of the stamp duty holiday are going to be solicitors, because they've been really under the cosh in terms of the sheer volume of work they've had to deal with in the last year or so. And they've been working 7-day weeks in some cases. And people don't normally have a lot of sympathy for solicitors, but they have really been under the cosh. So a period of less property transactions will probably be quite welcome for them. The perverse thing about the stamp duty, on 500,000, the full 500,000, the saving was, some £10,000, something like that. But people were going crazy on asking prices, paying £40,000 or £50,000 more to save a bit of money on stamp duty. The prices they were paying far outweighed the saving they were making on stamp duty. So that was a bit of a weird thing over the last year or so. Now, I saw a post and responded it to on Facebook, as I often do in some of the 100+ property groups that I'm in. And this guy said, I've got a couple of buy-to-lets. I think I'll sell them now, bank the cash, stick it in an ISA or something, or some interest-bearing account, or maybe even on the stock market, and then wait for the drop, wait for the crash, and then buy properties, similar properties in the same area of the country, buy that back cheaper, and I'll win out. Happy days. Now, I wasn't the only person to comment on that, but that is a plan that's full of flaws. So the easy bit is to sell it, yes, and if you caught the market at a high, which it's been through this year, you'll bank a nice tidy profit. And now, if they're buy-to-lets, it's not all yours, because when you sell a property or an asset that's not your main residence, you've got capital gains tax to pay. So you're not going to bank all the profit anyway. You're going to have you've got capital gains tax allowance, 12,000 and a bit. But if you made a decent profit, you're still going to have, a chunk of tax to go. So you don't get to keep all the profit anyway. But then you're going to shove it in the stock market. Well, stock markets are more volatile than property. So you might be making money, but it's just as likely that you'd end up losing money, and you'd have less when you want to pull it out. Now, you can pull your money out of stocks and shares a lot quicker than you can property, which you can just sell them on, at any day's notice, even the same day. So it's accessible, but what if it doesn't crash? And even if it does crash, how do you know when it's bottomed out? If prices are falling, when, given this guy's situation and this plan he's got, when would you actually say, right, I'm going to buy? Because you might buy it at a given date, 2 months later, the market's still falling. So, you've got to be pretty clever to time the bottom of a market. And you only, in most cases, this is property, shares, whatever, the only time you actually know that the bottom of the market's happened was a few months after it, when you can see that it's bounced. So, recipe for disaster, really. It's far more likely that he's going to lose money than make money on that strategy. Which brings me on to another point, actually. Now, timing the market and when you get in and when you buy is all very well. But if you're a landlord, you're in it for the longer term, 5 years, 10 years, 20 years, whatever that might be. Now, the reality is that when you buy it isn't that important. So if you bought in 2020 or 2021, the relevance to the price of your property in 2030 or 40 is not that great. And if you bought in 2019, well, you saw a bit of a dip, and now maybe it's come back a bit. It's so it's not that important. If you're flipping, very important, because trying to flip in a falling market is a skill indeed. That's very hard to do. But if you're going to be a landlord for the foreseeable future, then it becomes less important where your timing of entering the market. Now, it used to be said that property prices doubled every 7 to 10 years. Well, that might not be the case in the future, but you would expect it, let's say, to double in most parts of the country in 20 years' time. So, if at a given point, whether it's 10, 15 years, whenever that might be, your property is worth double what it made, what you bought it for. How important really is it that you squeeze an extra couple of percent by timing it right? So perspective is a really important thing here. So, if you're looking to add properties and you're looking to do it in the next few months, before the end of the year, things might quieten down. Once we get into October and the stamp duty holiday is finished, but maybe not a lot. But even if they do quieten down, they're going to bounce back. So, the advantage is not particularly that great. The fundamental thing, and this is the real big thing here, the fundamental thing to remember is the UK mainland is a small island comparatively. It's a pretty small land mass, and it's pretty highly populated. There's always used to be this comparison that France is 6 times the land mass, but pretty much an equivalent population. So, we're pretty squeezed in the UK. Now, that means that, there's a lot of pressure on places to live, and the government consistently misses, even though they're getting closer, I believe, but they consistently miss the target for new properties, not necessarily greenfield, but brownfield too, that they need to be building, or not they, but house builders, they need to encourage house builders to build these properties to maintain the housing requirement for the UK. Now, they're not doing that. They haven't been doing it for years, decades. So there's a pressure on enough places to live. And you've only got two ways to inhabit a property that you want to live in. You either own it or you rent it. Now, there's a significant swathes of the population that their circumstances, for a variety of reasons, are such that they cannot get mortgages. It may be bad credit, it may be insufficient income, it may be insufficient savings, it may be the wrong age or the wrong age group. So there's all these things that stop people getting mortgages. And if they can't get a mortgage, but they still need somewhere to live, where are they going to live? Rent. They've got to rent. That's the issue. So there's always going to be a market for rented property. Now, the private rented sector is at the moment filling the gap because the public sector isn't showing any overdue, or over the public sector isn't showing any inclination to get back into renting property in any significant numbers. And that would need to happen, or some other thing would need to happen, before the private rented sector as an entity gets squeezed out. So there's a demand that is pretty constant for rented properties in the future. And of course, we're not talking just residential, we're talking commercial too. So there's a whole bunch of commercial businesses that need to rent as well. You don't have to focus on resi. So the outlook for the property market generally is, leaving aside any short-term dips, that it's broadly it's broadly a solid investment. Now, I said I was going to tell you about the experts, so let me tell you about that. So at the beginning of lockdown 1, April 2020, I listened to, or watched actually, a webinar by Savills, hugely respected premier estate agent. And they wheeled out their top statistician. It's a tough word to say, isn't it? So they wheeled out this guy, and for about 20 minutes, he gave a whole load of slides, historical data, and that backed up his prediction for property prices in 2020 because of the pandemic. He said there was going to be a V-shaped dip. So property prices from April 2020 onwards would plunge but recover, and by 2025 be pretty much where they would have been if COVID hadn't happened. That's it. But the plunge bit, this is interesting, isn't it? Because the prediction, based on all scientific data and historical data, was that by December 2020, the UK housing market would have dropped by 5 to 15%. Didn't happen, did it? So all that data from someone as clued up as this fella, he still got it wrong. So, if a top statistician can't get it right, what chance have the rest of us got? So people predict a crash. I remember people 15 years ago that were saying, "Oh, property's too dear. I'm not buying property until it crashes." That did happen in the credit crunch. But these things do come along. But I think the overriding thing, as I say, is to just understand that property isn't really going to be going anywhere anytime soon. So if you want to buy a property and you can find the property that you think is right for you, then trying to time the market, you're probably going to lose out more than you win. So there we are. If you enjoyed that, I'll be back next week with another property finance tip. Before you go, just hang on here, I've got something I want to show you.
If you enjoyed watching this video, did you know every Monday morning at 8:30 I do a live Facebook Q&A. So if you want to start the week with checking out some answers to your property finance questions, click the link here.